Hello, I'm Mark Abssy, Head of Indexing at Tematica Research, and welcome to the week ahead. Well, the week is just about over, and it was a bit of a tough one, right? We had some economic news come out in the beginning of the week, PMI, manufacturing, people got a little shaky on that. There was some other AI-related news that folks weren't too happy about. Middle of the week, and we kind of settled in a little, still downward trend, but okay. Jolts came out. People weren't sure about that. They needed some corroborating evidence, which came today. And today was kind of where the shoe dropped a little, at least for the week. If we're looking at broad indexes, the more tech exposure you had, the worse you did, right? So, the Dow down just under 2%, the S&P 500 down about 4.25%, and the NASDAQ Composite down about 5.8% for the week. Everything kind of got whacked a little, right? Of course, cryptos were off as well. Ethereum taking a little harder than Bitcoin, down about 12.5%. Bitcoin down about 9.8%. One asset class that did very well this week, of course, risk, in the form of the VIX, which was up about 33% on the week. And then gold, I wouldn't say it rallied, but it held in. It was up about 54 bips, still at all-time highs, right above $2,500 an ounce. But not the safe haven. Let's say that it used to be in times like this. In terms of sectors, at the end of the week, staples up about 60 bips, real estate up about 20 bips. Everything else lower. Again, technology not where you want it to be. Certainly as a short-term trader, right? That sector down about 7.5%. Energy is interesting. It was the second lowest this week. Of course, oil prices have been declining fairly steadily. I know where I live here in the Northeast, we're seeing gas prices at the pump under $3, which is something we haven't seen in a while. Now, while that's going to bode well for future inflation numbers, kind of the jury is still out as to what that's going to mean overall for the consumer. Just thinking about the consumer, unemployment today came out. It ticked a little stronger, right? The last unemployment figure we got was 4.3%. Today came out at 4.2%, so that's a slight strengthening. And still, it didn't do much to assuage the actual payroll numbers, which came out lighter, a fair bit lighter than what was expected. And of course, this all feeds into expectations for what the Fed is going to do when it meets on the 18th. And it's actually interesting because there was an article that I was reading about Economist Survey and what they thought the Fed was going to do here and there. And it's interesting because the article initially talked about how, cities calling for 350 bip hikes before the end of the year. Of course, what it failed to mention was that given certain criteria. But it is interesting to note that given what we had today, right, 4.2% on inflation, payrolls coming in between kind of 125 and 149 when they came in at like 140. That the majority of people are still seeing 25 bips for the meeting on the 18th. B of A kind of stands out there. They're still saying 50. I don't know that I see 50. The Fed certainly hasn't talked about 50. And in previous videos that I've made, I've talked about how Powell, talks about how he is data dependent, not data point dependent, right? And I think people really need to listen to that because there isn't going to be a number which is going to cause him to throw up his head and say, 50 bips, let's go. So just, keep that in mind. I think everyone's sold on 25 bips now. I think even the Fed is sold on 25 bips, of course. And then, as far as other cuts go, if history is any guide, and of course the meeting schedule, they'll do 25. We'll have an election, and then we'll take it from there, right? One thing I thought was interesting in the beige book that came out this week, there were 7 instances of use of the word weakness but there were 11 instances of the use of the word slowdown. And from what I understand, those are pretty high numbers to come out of the beige book. So the Fed's certainly aware of what is going on. I don't think that there are any major surprises there for them. I'm just trying to think if there's any particular stories, movers today. I mean, Tesla's down like 8.5%. And I don't know if that's due to what the company is doing or what their owners' extracurricular activities are, or how much that is playing into it. But they certainly have been kind of taking it on the chin so far this quarter and so far this year. In fact, if I look at Mag 7 names, quarter to date, two of them are up, right? Apple, and believe it or not, Tesla is up quarter to date. So, maybe that's some profit taking, maybe that's something else, I don't know. But of course, NVIDIA has been taking some lumps this quarter, down about 17%, Microsoft down about 10, etc. Down the line. Meta's kind of hanging in there, still down, but, down like 80 bips, right? So, no kind of major story there. Let's see. So this week again, some shaky news. People didn't like the employment stuff today. There are some calls for 50 bips in the Fed meeting a couple of weeks from now. Again, I don't know that I see that. The Fed has never been reactive in that sense, right? Looking to next week, kind of a light week, except we have two potentially big numbers coming out, right? We have CPI coming out on Wednesday, and then Thursday we have PPI, right? And CPI, the expectation there for the headline number is to come down to 2.5% from the previous 2.9%. But we're seeing the core, or at least the expectation is that core is going to hang steady there at 3.2. So, again, lower numbers than what we've seen. Headline coming down. My guess is that has to do more with energy than anything else, given the recent decline and the continual decline in oil prices. On PPI, similarly, the headline number expectations are calling for 1.7% down from 2.2, and then ex food and energy flat at 2.4. Although I guess that doesn't really tie into my energy story, but we'll see. We'll see what happens. One other thing that happened kind of ties into the current week, not the next week. I think it was on Friday. The yield curve finally uninverted. So this recession indicator that everyone's been talking about being a recession indicator for almost 2 years finally unwound, and so I guess chalk that up to experience. Indicators are just that. They're not kind of ironclad proclamations, right? Friday we'll get Michigan sentiment, and it's expected to tick higher to 68. What's interesting, and this is for the technicians out there, Michigan sentiment has been bouncing around a little, but for the last while, last 5-6 months or so, it's been making higher highs and higher lows, and of course that is a bullish signal. In terms of companies and earnings, we're gonna look. Well, we're gonna get some more consumer sentiment numbers, or at least kind of proxy consumer sentiment numbers from a number of names this coming week. Signet Jewelers, Cracker Barrel, Designer Brands, the parent company for DSW Shoe, Academy Sports and Outdoors, and then of course Dave & Buster's. So we're going to get some updates on consumer spending over the quarter. I don't know that there's going to be anything radically different from what we've heard already from peers of these companies, but as always, we'll stay tuned. Oracle, of course, is going to report on Monday. It'd be interesting to see what, if anything, they say about their recent acquisition of Paramount. Adobe, is kind of a big name, of course, and they're going to be reporting, I think it's Wednesday or Thursday of this week. And then, of course, everyone's favorite retail name, GameStop, is going to report this week as well. So, You know, this past week has been kind of rough, but it's kind of expected, right? We've seen, and these markets are at all-time highs coming into September, and I don't know if it's because people are back from vacation and they're reading the newspapers and looking at the reports again, saying, "Oh, things are a little different," or not. But we had some selling this week. Sure, that's fine. It's understandable. The big thing is, of course, is what is the Fed going to do in the middle of September? Again, expectations are 25 bips, and I think that's just what they're going to deliver, right? In terms of models, in terms of our model suite, of course, heading out this week, our kind of highest performing model, which frankly put on a lot of its weekly gains today, it is our market hedge model, right? Up about 8.5% over this period. And again, the more tech heavy, tech focused models have been lagging this week. Overall, I mean, things are down overall. Aging of the population and market hedge were the only ones really that were positive. Other models were kind of in the 0 to 1% range, and then it just kind of goes from there. There's a bunch around kind of the 4 to 5% range, and then you have kind of the big hitters, right? CHIPS Act, and then we did see some selling in some of the nuclear energy and uranium model names. But again, it really comes down to what's going to happen with CPI and PPI, and then of course the week after is of course the Fed meeting. So that's kind of the update from here. Hope you all had a good summer and everyone's back in school and the house is getting back to normal. All right. So good having you, and we'll see you next time. Bye bye.